Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Okay, let's jump right in. This video presents a direct informational narration of the source document, U.S. Market Peripheral Notes for March 18, 2026. We're going to walk through what this report is saying about what's moving the markets, especially with how incredibly volatile things are right now.
First up, a quick but very important notice. This document is for informational and research purposes only. It isn't investment advice, a recommendation, or any kind of offer to buy or sell. Investing has significant risks, so any decisions you make should be your own.
So, here's our game plan. We'll kick things off with the big geopolitical stories, the ones causing all this turbulence. Then, we're going to zoom right in on the technical charts to see what they're telling us. After that, we'll hit some key industry themes, and then we'll wrap it all up with a clear strategy that comes directly from this analysis.
All right, let's dive into our first section, geopolitical developments. The big takeaway here from the source is that, the old rules just don't seem to apply right now. The market isn't trading on the usual stuff like economic data. Instead, it's being pushed around almost entirely by geopolitical risk, especially everything that's unfolding so quickly in the Middle East.
And this is where it gets really interesting. How the market reacted to some pretty shaky headlines. So rumors started swirling about a 15-point U.S. ceasefire proposal. Then, President Trump chimed in suggesting the deal was close and boom, index futures just soared. But here's the twist. Before the market even opened for the day, Iranian officials came out and flatly rejected the whole thing. They even laid out some incredibly harsh preconditions, and yet the market still opened higher.
So you gotta ask, why did that happen? Well, this brings us to a really crucial concept from the report called short covering inertia. The idea is, even though that positive news turned out to be false, the initial upward push was just so strong. It was fueled by all these traders scrabbling to close out their short positions, their bets that the market would fall. That momentum just carried the market higher at the open. It was, as the report puts it, an illusion of strength.
But beneath all this headline chasing, there's a very real threat that's causing all this anxiety: the potential for a dual strait blockade. We're talking about two critical choke points. First, the Bab el-Mandeb Strait, which handles about 12% of global seaborne oil, and then, of course, the Strait of Hormuz. A combined closure of these two, wow, that could slash the global daily oil supply by a staggering 25%. And here's a key point from the analysis. While the White House talks about a 4 to 6 week military plan to reopen them, the document suggests that this timeline actually highlights a potential gap in U.S. defensive capacity.
Okay, so let's shift gears and move to our next section. We're going to put on a different lens now and look at the technicals. How is all this geopolitical stress actually showing up in the market's charts and indicators? Because in an environment like this one, the charts, they start to tell a story about a very specific kind of trader psychology.
The big number to watch, according to this, is 6,700 on the S&P 500. It's become this line in the sand, a level the market just can't seem to break through. The recent bounce? The report describes it as just an oversold repair, basically a knee-jerk reaction driven by those false headlines. And it suggests that if we don't see any real diplomatic progress by Friday, a retest of the 64.75 support level is looking very plausible.
Okay, now listen to this. The report points to something it calls an extremely dangerous macro signal. The S&P 500's one-month implied correlation index, it has spiked to an extreme level of 0.4. So what on earth does that mean? Well, in simple terms, it means everything is starting to move together. All the different stocks, all the different assets. And in the market, when that happens, that is a huge red flag.
And this really gets to a core market principle that the analysis highlights, and that is, when crisis hits, the correlation of all assets moves toward one. This is the market basically screaming that traditional diversification, spreading your risk around, is failing. It's not working. Because when everything moves in lockstep, there's simply nowhere to hide.
And this rising correlation, it sets the stage for something called liquidity exhaustion. The document describes this as the final and most painful phase of a sell-off. It's the point where market makers just can't manage their risk anymore, and they're forced into this collective, almost stampede-like selling just to protect themselves. So the report is pretty clear. Until that correlation index starts to turn back down, the broader market is just incredibly vulnerable.
All right, on to our third section, which is all about industry themes. And this is where things get kind of weird. See, despite all this weakness in the overall market, the report points out this really strange divergence. There's a huge amount of money just pouring into a select handful of companies, the ones with these epic narratives. And this can create this sort of false sense of prosperity that really masks what's happening just beneath the surface.
I mean, just look at the semiconductor space for a perfect example. On one hand, you have ARM surging up over 16% on news that Meta is favoring its new in-house CPU. Then you have AMD and Intel, who are actually planning to raise prices by 10 to 15% because of supply disruptions. But on the other hand, you've got the storage names, like SanDisk and Micron, and they're facing selling pressure. Capital is rotating out, using news about Google's new memory reduction tech as the excuse. It's a stock picker's market, for sure, but a very treacherous one.
And another one of these epic narratives, the whole space exploration theme, the big rumor making the rounds is that SpaceX could file for its IPO as soon as this week. And the target valuation, it's just mind-boggling. We're talking $1.25 trillion. And get this, that number is supposedly down from a previous rumor of $1.75 trillion. If this actually happens, it could be the single biggest fundraising deal in history. Just massive.
And if you want a classic example of just how unpredictable things can be, let's talk about Chinese ADRs. Those are the Chinese companies listed on U.S. exchanges. So Pinduoduo reports earnings. Their revenue growth was 12%, which was a beat. But their net profit of 26.3 billion RMB? That was a miss. So what do you think the stock did? It rallied. This just underscores a key risk factor from the source. In this particular space, good news can sell off and bad news can rally. It's completely counterintuitive.
Okay, let's bring this all together in our final section. We've looked at the geopolitical tensions, we've seen the technical warning signs, and we've touched on some of the strange things happening in certain industries. So what does it all mean? What's the bottom line? And what's the recommended strategy coming out of this document?
Okay, so the most important watch point, according to this analysis, is the Magnificent 7 ETF, ticker MAGS. It tracks those huge tech giants. The key thing is it's still struggling below its annual moving average. And the analysis notes that historically, a genuine market bottom is formed when these heavyweight leaders finally stabilize, not because of some speculative frenzy in smaller stocks. So as long as MAGS is weak, the report says the bottom is not yet welded in place.
And that leads directly to a very clear two-step defensive strategy that's outlined in the document. Step 1, defense first. As long as that dual straits threat is looming, every little market bounce should be seen as a chance to reduce your exposure and build up cash. Step 2 is more for traders. The focus should be on Friday's de-risking flows, how people position themselves before the weekend and waiting for that critical correlation index to turn. Until then, the document frames retaining cash as really the only winning move.
And this summary statement from the document really gets to the heart of the market's psychology right now. It says the market is trading the game around Trump's willingness to protect equities rather than genuine geopolitical peace. In other words, it's a bet on politics, not a bet on actual peace.
And just before we wrap up, we have one final professional risk disclosure to go over. Please remember, this document is provided strictly for informational and educational purposes. It is not financial advice, and it's not a recommendation to buy or sell anything. Trading involves substantial risk, and any investment decision you make is entirely your own.
And that brings us to the end, so I'll just leave you with this final thought to chew on, which really comes from the core of this analysis. In a market that's being driven by psychology, not fundamentals, how do you even begin to distinguish a true signal from all of the noise? Something to think about. Thanks for joining me.